Right now, somewhere in Los Angeles, a small robot is quietly making its way down a sidewalk. It isn't carrying groceries for a science experiment. It isn't being tested by engineers, and it isn't part of some futuristic movie. It's delivering someone's dinner. Most people walk past it without giving it a second glance. To them, it's just another strange machine on the sidewalk. But almost nobody realizes they're looking at something much bigger than a delivery robot. Because behind that tiny machine is a publicly traded company. A company that was never supposed to survive. A company that began as an internal experiment, was pushed out by one of the biggest tech companies in the world, and somehow found its way back. Today, investors know it by a simple ticker, SERV. And whether this becomes one of robotics' biggest success stories, or just another forgotten startup, could depend on what happens over the next few years. So how did a small delivery robot become one of the market's most unusual bets? Let's rewind. In 2021, Uber made a decision that most people barely noticed. Inside the company, a small team had been working on autonomous sidewalk delivery robots. The idea sounded simple. Instead of paying a human driver to complete every short-distance food delivery, why not let a small electric robot handle the final trip from the restaurant to the customer's door? No steering wheel, no driver, no fuel. Just software, cameras, sensors, and electric motors quietly doing the job. On paper, it made perfect sense. The last mile of delivery is often the most expensive part of the entire process. If that cost could be reduced, even slightly, it could change the economics of food delivery. But there was one problem. Uber wasn't built to become a robotics company. Its attention was spread across ride-sharing, global expansion, competition, regulation, and profitability. Building autonomous robots required enormous amounts of time, engineering talent, and capital. So Uber made a choice that surprised many people. Instead of shutting the project down completely, it spun the business out into an independent company. Uber kept an ownership stake. The robotics team got a chance to continue building, and the rest of the world moved on without paying much attention. At the time, it looked like another small corporate experiment, quietly leaving the spotlight. History is full of companies like that. Most disappear. Most never raise enough money. Most never reach meaningful scale. Most become little more than forgotten press releases buried somewhere on the internet. Serve Robotics refused to follow that video. Instead of disappearing, it kept building, one sidewalk at a time, one restaurant at a time, one delivery at a time. That slow, almost invisible progress may be the most interesting part of this entire story. Because while headlines were chasing artificial intelligence, electric vehicles, and billion-dollar startups, Serve Robotics was focused on solving a much smaller problem. How do you move one bag of food from a restaurant to someone's front door as efficiently as possible? It sounds almost boring, until you realize how often that problem needs to be solved. Millions of times, every single day. And that's where this story starts becoming much bigger than a tiny robot rolling down a sidewalk. For years, Serve Robotics operated mostly outside the spotlight. There were no flashy product launches, no billion-dollar headlines, no celebrity CEO making bold promises on stage. Just a small company trying to prove that autonomous delivery could work in the real world. Not in the laboratory, but on busy city sidewalks where people, pets, bicycles, construction zones, and unpredictable traffic are part of everyday life. And that's a much harder challenge than it sounds. Building a robot that can move from point A to point B is one thing. Building one that can safely navigate crowded sidewalks, stop for pedestrians, avoid obstacles, cross streets where permitted, and deliver food without damaging it, thousands of times, is something entirely different. Technology only matters if it works consistently. That's what investors wanted to know. Then something interesting happened. Serve Robotics wasn't asking millions of customers to download a new app. It wasn't trying to replace Uber Eats. It wasn't competing against DoorDash. Instead, it quietly became part of the system that people were already using. When someone opens Uber Eats and places an order in a supported area, they usually don't spend much time thinking about how that food will reach them. They simply tap a few buttons and wait. Behind the scenes, however, software decides how that order should be delivered. Sometimes it's assigned to a human driver. Other times it may be assigned to a Serve Robotics delivery robot. From the customer's perspective, almost nothing changes. That's a surprisingly powerful advantage. History has shown that consumers rarely enjoy changing their habits. The products that spread the fastest often don't force people into new routines. They simply make an existing routine better. Streaming didn't invent entertainment. Online banking didn't invent money. Ride-sharing didn't invent transportation. They made familiar experiences more convenient. Serve Robotics is attempting something similar. Not by changing how people order food, but by changing what happens after they press place order. And if that approach succeeds, the opportunity could become much larger than it first appears. Think about the economics for a moment. Food delivery companies operate on incredibly thin margins. Every delivery comes with costs: driver pay, fuel, insurance, vehicle wear and tear, time spent waiting at restaurants, traffic delays. Every dollar saved on a successful delivery matters. Now imagine a future where a meaningful percentage of short-distance deliveries can be completed by autonomous robots instead of traditional vehicles. Even small improvements, repeated millions of times, can become significant. That's the bet many investors are watching.
Not because robots look futuristic, but because reducing delivery costs has real financial value. Of course, a compelling idea isn't enough. Every startup has an idea. The question is whether the business is actually growing. That's where the numbers become important. Serve Robotics is still a relatively small company. Its revenue remains modest compared to established technology businesses. The company is also not consistently profitable, which means it's still investing heavily in expansion, operations, and technology. For conservative investors, that's an obvious risk. Young companies often need additional funding before they become self-sustaining. Some make it, many don't. But growth investors usually ask a different question. Not, how big is the company today? Instead, they ask, how big could this company become if everything goes right? That's a completely different way of looking at the same business. Management has outlined ambitious growth plans, aiming to expand both its delivery network and its robot fleet over time. If those plans succeed, today's financial numbers could look very different several years from now. But there's one important word in that sentence: if. Because in investing, the future is never guaranteed. And that's exactly why opinions on Serve Robotics are so divided. This is where the story becomes more complicated. Because it's easy to fall in love with a great idea. It's much harder to build a great business. History is full of companies that promised to change the world and never generated meaningful profits. Investors have seen revolutionary technologies before: 3D printing, virtual reality, self-driving cars, flying taxis. Some eventually found their place. Others spent years burning through billions of dollars before reality caught up with expectations. That's why experienced investors don't just ask, is the technology impressive? They ask something far more important. Can this become a sustainable business? Serve Robotics still has a long way to go before answering that question. The company remains in the early stages of its journey. It's still expanding, still investing,
still proving that its business model can scale. That means real risks remain. Competition is one of them. Serve Robotics isn't the only company trying to automate deliveries. Large technology companies, robotics startups, and delivery platforms are all exploring similar ideas. The race isn't simply about building the smartest robot. It's also about manufacturing at scale, keeping costs under control, earning regulatory approval, maintaining reliability, and convincing restaurant partners that the economics make sense. Even small execution mistakes can slow growth. Then there's another challenge many investors overlook: cash. Growing a robotics company isn't cheap.
Every new robot requires hardware, software, maintenance, testing, support, and continuous improvements. Unlike software companies, where a new customer can often be served at almost no additional cost, robotics businesses usually need physical equipment for every expansion. That makes scaling more expensive. It also means investors should pay close attention to future funding needs and how efficiently the company grows. So why are people still interested? Because the potential market is enormous. Every single day, millions of meals are delivered around the world. If autonomous delivery becomes a meaningful part of that industry over the next decade, companies that establish themselves early could benefit from a powerful long-term trend. That's the opportunity. Not a guarantee, an opportunity. And there's an important difference between those two words. The market doesn't reward great ideas. It rewards companies that successfully execute those ideas. Serve Robotics still has to prove it can do that. Maybe it becomes a major player in autonomous delivery. Maybe it remains a niche business. Maybe a larger company decides it's valuable enough to acquire. Or maybe the economics simply never work as well as investors hope. Today, nobody knows. And that's exactly why this stock attracts both believers and skeptics. One group sees a small company positioned at the beginning of a potentially massive industry. The other sees an unprofitable business operating in one of the most difficult sectors imaginable. Both arguments deserve to be taken seriously. That's what makes investing interesting. And that's what makes Serve Robotics worth watching. Not because the outcome is certain, but because it isn't. The biggest returns in history often came from companies that looked uncertain in their earliest years. At the same time, thousands of promising startups disappeared before they ever reached profitability. The challenge is knowing the difference. So the next time you see a small robot quietly rolling down a sidewalk, don't just see a machine delivering dinner. See a business trying to solve a problem that affects millions of deliveries every single day. Whether that business eventually transforms the industry or becomes another forgotten experiment is a story that's still being written. If you enjoyed this breakdown and want more deep dives into overlooked companies shaping the future, subscribe and join me for the next one. And remember, this video is for educational and entertainment purposes only. It is not financial advice. Always do your own research, consider your own financial situation, and consult a qualified financial professional before making any investment decisions. Thanks for watching, and I'll see you in the next video.